Can I first of all start off by saying a huge welcome to all of you to Albion's first virtual shareholders conference. For those of you who don't know me, I'm Patrick Reeve, formerly managing partner and now chairman of Albion. And although it is a shame not to be with you in our normal magnificent livery hall with great views of the Thames and the prospect of a serious buffet lunch with wines to match, it really is great to have so many of you here online. So I think that we'd all agree that these are properly strange times. I'm sure that all of you, like me, are getting really bored of them. But the one thing that this extended crisis does prove is how astonishingly adaptable mankind really is. We've now got all of our routines, and in fact, from a standing start and with no rehearsal really at all, we all adapted to the new normal within a matter of days. And within Albion as well, looking after your money, we've been investing in new companies, divesting from older ones, and helping our existing management teams when they need them, with far less actual physical contact than we'd have ever thought was remotely possible. But although the world has undeniably become a stranger place than before, and so the focus of this year's conference is to look a little bit closer at some of our main concerns and to show you what we've been trying to do to attempt to address them. So now if you can move on to the slide with our speakers. First, we're lucky to have again Professor Trevor Williams, formerly Chief Economist at Lloyds Bank Commercial Lending, and now visiting professor at Derby University and lecturer at both Cass Business School and at Cardiff University. He'll be giving his thoughts on the economy, not an easy task, I might add, and he'll be answering any questions at the end as part of his Q&A, as part of our general Q&A panel. And then we move on to another one of our concerns, cybersecurity, with Jenny Radcliffe. So Jenny describes herself as being a social engineer, an expert in the psychology and tactics behind social engineering. She'll give her thoughts on the scale of the cyber problem and how we might address it, and we'll have a short Q&A for her straight after her own talk. And our third area of concern is, not surprisingly, healthcare. And here we've got a panel chaired by Pam Garside, a director of Crown Place VCT. She's also a Cambridge business angel and has a long record of leadership in the healthcare sector. She'll be joined by Dr. Andrew Elder, who's Albion's head of healthcare, alongside the chief executives of three of our investee companies, Dr. Ahmed Sharabani of Locum's Nest, Chris Brinsmead of Provica, and Richard Andrews of Helios. And then we got Will Fraser-Allen, managing partner of Albion, who'll be reporting on how your money has been performing over the past pretty unusual year, what the key events have been, and where the prospects are heading. And finally, we've got the Q&A session. And at the bottom of your screen, you should see a little Q&A button, and you can type in your questions at any time during the conference. We may not have time to answer all of them within the time permitting, but for those who we won't, we'll try and get to you written answers over the next few days. And we've got a great panel to deal with them, both Will, Trevor, and Andrew, who've been speaking earlier, and then two colleagues from the tech investment team, Jessica Bartos and Albion partner Robert Whitley-Smith. So can we move on to my next slide? Before I pass you over to Trevor, this is my current favorite quote, and it does show that some things really don't change. This was said by Earl Wilson in the 1950s, and it's very, very thought-provoking. So if I can pass it over now to Trevor Williams. Thank you very much.
Thank you very much indeed, Patrick, for that wonderful introduction. I have one quote actually that I do like. It's more an economist's joke. How do you make God laugh? Tell him about your plans for the future. So there's a lot going on in the world, as everyone is well aware. I'm going to look at those bits of what concerns us more immediately, and as we go into 2021 and some of the longer term trends as much as I can in the time allotted. So The next slide, please. Of course, everyone knows that we are experiencing the worst global pandemic since the 1918 Spanish flu. It's clearly resulted in a global recession. World growth is likely to contract this year by about 5% or so. Our economy will decline by around twice that, but we've already seen global monetary and fiscal policy loosen dramatically. There may well be more depending on how things evolve over the coming months. Here, bank rate has been cut to 0.1. QE now stands at 185 billion. Fiscal deficit will be around 360 billion or so this year, roughly 17% of GDP. Debt to GDP ratio is already blown out above 100%. So over 2 trillion of outstanding debt. Next year, of course, not least, Brexit will be taking place, just to add to the disruption that we may face. A trade deal, by the way, is in doubt. And even if there is one, there will still be disruption because at the very best, it would be an FTA, a free trade arrangement, Canada style, but it won't be that because there is no time for that to take place. Here's the good news, amidst all of that, there will be growth next year. Winners from the current pandemic are tech, the well-off, losers are the less well-off. The hospitality, travel, leisure sectors have been particularly badly hit. Meanwhile, of course, financial markets have been recovering, underpinned by loose fiscal and monetary policy, and in my view, something which will be discussed, hopefully, and I'm sure will be in the panel, around the technological revolution, which is ongoing and is occurring despite all of the events that we see occurring around us. Next slide, please. So, just to note, there is a vaccine being announced, but we don't know how it works yet and its effectiveness. And so the rollout will take some while, but that is, of course, unequivocal good news. The death rates, as you can see, have been high and are still rising. And indeed, we have had some acceleration of cases as the winter has approached and as people have been indoors more, which has facilitated the spread of the disease, never mind the fact that we've not fully come to terms with track and trace and so on. So next slide, please. That's the context within which what's occurring is taking place. Just to illustrate the point about the decline in GDP that's occurred though, this slide just graphically illustrates it, that every one of the advanced economies have seen severe declines of at least 10%, that our decline in the first half of the year has been over a fifth, that the European economies have fallen more sharply than some of the other advanced economies, and that our performance in context has been one of the worst. Next slide, please. The point to note is, of course, that there will be a contraction, but the economic effects are worse than that. The economic effects are actually, and should be, compared with where would growth have been without this health scare? Well, it would have been up, it would have been positive. So the hit that we're having to our economy is based on the turnaround in growth. And so on average, the turnaround has been at least 8%. So world economy has been expected to grow by 4% this year. Now it's contracting by about 4 to 5%. So the turnaround has been at least 8 to 10%. And it's that large impact which has meant the economic effects have been even more significant than they would be otherwise. In other words, we didn't expect this to happen. So the resources which are lying idle are far greater than they would have been otherwise. Next slide, please. In response, of course, monetary policy has been loosened aggressively virtually everywhere. Where they were negative, like in the Euro area, Japan, in Switzerland, they became more negative. Where they were slightly positive, they dropped close to zero. So for us, it dropped close to zero. For the US, it became zero. Is there a potential for further cuts in interest rates? Well, if you look at interest rates in markets and the way they suggest the official policy stance could be, they actually suggest that UK interest rates could be slightly negative for the next 2 to 3 years. Next slide, please. Alongside the loosening in monetary policy has been this huge loosening in fiscal policy. It'd be interesting, as I've done here, to compare it to the response to the global financial crisis, which of course was a 1 in 100 year event. This event is another 1 in 100 year event. So the 1 in 100 year event probability has doubled in the space of 12 years. In other words, we seem to be more prone to crises which affect the world economy and have profound effects. Small probability, but very high impact. The increase in debt as a percentage of GDP in the global financial crisis was around 10%. The increase in debt in this crisis is nearly 20%. So that highlights the severity of the impact that this crisis is having on our economy. It's partly, of course, because we can't raise taxes, so we're seeing the hit to revenue, but also we're seeing the increased spending that has entailed in this crisis. Next slide, please. But the good news is that recovery has begun as lockdown has ended, or as eased. Remember that this is a crisis that did not start in the real economy, nor did it start in the financial sector, as did the 2008-9 crisis. This is a health emergency which forced the authorities to mandate closures of large parts of the economy in order to save lives through reducing human interaction. To that extent, we could argue that the recovery should take place as soon as the lockdown is eased. And the probability of that occurring is shown here, which is that there has been a pickup as lockdown has ended and as we have learned lessons. Of course, we all know that there's been a return to partial lockdowns in the current quarter, but it's not as severe as it was at the beginning of the year. The recovery is expected to continue, and obviously, as you can see from this graphic, for the advanced economies, for the particularly the G7 economies, the level of output, even at the end of 2021 Q4, is still expected to be lower than it was before this crisis started, which is to say, taking us back to Q4 of 2019. Next slide, please. As I mentioned there, renewed lockdowns can curb the extent of the recovery and could lead to some retreat from the pace of the pickup that had been taking place, and that's absolutely the case. So, for instance, we had yesterday UK Q3 GDP figures. It suggested the biggest quarterly rise since 1955, an increase of over 15%. But given that lockdown has been imposed over the past week, it's likely that the economy will contract by about 5% in the fourth quarter. In other words, the expectation shown here that there may well have been a recovery in the fourth quarter of this year is not now likely to take place. Instead, we will have a contraction this year, Q4, which means that effectively growth this year is likely to be about 10% below the level that we saw at the end of 2019. Next slide, please. But the good news again is that particularly if we have a vaccine which helps to ameliorate these effects, maybe in the medium term rather than the short term, I don't think it's going to change anything for Q1 and Q2, but it could potentially make a significant difference in the second half of 2021. We're likely to see a widespread recovery taking place everywhere in the world. And this graphic just illustrates the fact that there will be significant bounce backs taking place, which will clearly help to boost recovery prospects in other economies as well. And what's notable, of course, is that of the largest economies in the world, China is the only one that will see positive growth this year and even more positive growth next year. Next slide, please. But it may take 4 years for the UK, for instance, to regain its pre-COVID 2019 peak level of GDP. So we're going to have effectively a 90% economy for the next 2 to 3 years. Next slide, please. By the way, the lost implied output is around 450 billion. That is to say, if we had continued on the previous trend of growth, the economy would be nearly $500 billion bigger. That's a significant hit to our living standards. We must still look at scenarios, of course. The central view is that we contract by around 10% or so this year, peaking unemployment in the next year or so will be around 9.5%, public sector debt levels off at over 300 billion, and public debt sticks at around 105% of GDP. But if things are worse than that, then we could see the contraction being deeper, and we could see clearly debt levels far higher than the ones in the central scenario. But let's be somewhat upbeat. Maybe the vaccine comes through far more quickly, it's far more effective, and things do turn around more rapidly, in which case the contraction this year may not be as great as is implied in the central scenario. Nevertheless, you can see that in none of these scenarios do we see a possibility of any positive growth significantly, at least before the end of this year. Next slide, please. Government debt is rising fast, and we should be worried about how we're going to pay for that, but some context is required. This is a chart which shows the historical performance of debt during various crises and during various points in the UK's economic history. You can see that it's high, of course, during periods of war, and then in periods of peace, it falls quite significantly. So growth reduces debt, by the way, more quickly than tax rises will do. So we want to have the focus on how to grow the economy with policies and encouragement and spending in infrastructure and fiscal policy, for example, which is directed towards boosting growth. So we are seeing an increase in debt, but in my view, it still remains manageable. Next slide, please. In particular, it remains manageable because we're seeing negative borrowing costs. Excluding coupon payments, governments are being paid to borrow, and it goes very far out the curve. Therefore, government spending can be at least directed towards parts of the curve where it's least expensive to do so, which is to say that in nominal terms, they're basically hardly paying back any of the outstanding level of debt. Of course, the coupon payments have to be made, so those who are buying this are still seeing some positive returns. But that is some good news. By the way, historically, one of the effects of pandemics is to lead to real negative yield curves. And by the way, the study of half a millennia of data suggests that negative yields can remain in place, adjusted for inflation, for up to 20 years. Next slide, please. With looser monetary policy and fiscal policy, so part of the reason why money supply is rising so quickly is that the public sector share of money supply in the UK is rising fast because the authorities are buying so much debt. They're buying all of the debt, in fact, which has been issued by one arm of government. So as fast as the Debt Management Office issues it, the Bank of England buys it. So there's been a big surge in money supply. Next policy, next slide, please. The other part of the good news, and of course feeding into negative real interest rates, is that consumer prices is falling sharply. It's currently 0.7%. It's likely to remain below 1% for the next year or so. So inflation is not an issue. Next slide, please. And the maintenance of this loose policy stance can continue. Pay growth and therefore wage inflation is clearly no issue either, partly because of furlough, income growth has collapsed towards negativity in terms of nominal pay in some parts of the payment profile, with regular real pay being negative as well. So pay inflation is reflecting the crisis that we are facing. The good news from it, of course, is that you can maintain this loose policy stance to help to put in place the building blocks of recovery. Next slide, please. Of course, one of the effects of this crisis is that it's going to be felt for some time. It's going to reduce our capacity. It's going to reduce the level of employment and increase unemployment, therefore idle capacity, which implies, of course, lower growth of productivity and weaker growth overall. It also implies that the capital stock will be affected by this because investment is likely to be less in this kind of profile than otherwise, and therefore there will be a real hit to living standards, and lower productivity and lower growth will therefore result from this. It's lagged, therefore we're beginning to see the pickup of unemployment, but it really is not coming through to the extent that it will as this crisis evolves. And as I suggested before, it's going to peak out at least 7% and above. Next slide, please. Of course, business failures will take place too. We've not yet seen any of that. Low interest rates means that firms can put off the day when they'll make the decision about whether to shut down. Significant bits will shut down, of course, given the hit to particular sectors by COVID-19. This just implies that the share of jobs at risks due to the illiquidity that some sectors will face in the environment of very weak growth also implies where most of the losses for business failures will take place: accommodation and food, arts and entertainment. In other words, the sectors where people most closely interact with each other. Next slide, please. But good news is businesses are reopening. The ones that I mentioned previously are the ones that are open the least and have just been subjected to another lockdown. So there will be a cascade of business failures in that. For arts, entertainment and recreation, for example, over 20% of those firms may not survive this crisis, for sure, it seems to me. And accommodation and food services won't be hit quite as much, but it's going to be hit pretty hard. Next slide, please. 30% or so of the workforce are working remotely. And it does imply, of course, that there's a new inequality. Those who can't do this are being impacted with levels of income being lower and job prospects being worse, of course. But once again, we can see that for the overall economy, actually about 88% of it is working. And so that has got to be seen as good news. But the effects are very much differentiated by the sector that one is in, as this graph implies. And as I said earlier, it's the health, entertainment, and hospitality sector that's worst hit by this crisis. Next slide, please. Now, turning to Brexit, are we too complacent about the impact on the economy? Probably. I think that apart from those businesses that have been affected by this, most people think that it's over. But of course, it isn't over. We're still in the interim arrangements, and therefore the effects of leaving haven't been felt. They will be felt on the 1st of January 2021. Those businesses who respond, about 50% of them who are impacted by this, feel that it's almost, but not quite as important as COVID-19. And it comes across a range of sectors: so mergers and acquisitions, capital expenditure and hiring. All of those are going to be affected next year by us leaving the EU single market. Next slide, please. Of course, one of the remarkable things that we're seeing is that this hardly seems to be affecting sterling. It may well be that it's already priced in. To that extent, it won't have an impact when it actually occurs. But that seems to me somewhat surprising that sterling seems remarkably stable as we go into a period where there will be a significant trade disruption. And in my view, one of the impacts on the business sector does emanate from the exchange rate effect, which means that it will be more volatile. Next slide, please. Equity markets are already bouncing back. The flood of money into markets is clearly beginning to make a difference. It's underpinning much of the business activity that's taking place. So it's clear that there's been stabilization of equity markets. If you have access to capital, you can actually do really well out of this crisis if you can pick up assets quite cheaply, particularly ones that are going to grow in future and maybe even related to tech sectors, where there is value, of course, but also, broadly speaking, infrastructure. Next slide, please. Not all financial market signals are sanguine, however. So gold prices are higher, suggesting that they're still not convinced, and oil prices remain significantly below their peak, so reflecting the potential for weaker growth. And the final slide, please. So where does this take us? Well, in conclusion, one of the good news is that there has been innovation. There is more of it about. Firms are working smarter. As Patrick said at the beginning, adaptability is how one survives. Being strong is not enough. The smartest ones are the ones who adapt to changing circumstances, and that's as true now as it's ever been. Information and the power of information is more important than ever. The technological bias is digitization and how we use it. So it isn't all negative. There are opportunities to do things differently, to innovate, to fix the old problems, and solutions to new issues such as climate change and carbon reduction technologies. Banks can actually still make money even in a situation, and financial institutions, even in an environment where we have a flat or downward sloping curve. And one of the solutions to this is to embrace the technological revolution and to do more to get to where the next growth sectors are. And that will mean a speeding up of the pace of change. That will not be something that will be affected by this pandemic in the long term. So I'd like to leave you on that optimistic note and pass you back to others on this call that will fill in a lot of the gaps that I've left in my presentation. Thank you very much indeed for listening, and there'll be an opportunity for questions later on.
Trevor, that was fantastic. Thank you so much. And it's good to see you being slightly less optimistic than you normally are, because frankly, I rather agree with you. There remains quite a lot to worry about. But that was great, and thank you. And if I can pass you over to Jenny Radcliffe on cybersecurity.
Hi there, and thank you for having me speak at your conference. My name is Jenny Radcliffe, the Pico Hacker, and I'm going to give you a presentation today all about cybersecurity and social engineering. So why would a social engineer, I'll explain more later, talk to you about cybersecurity? Well, little few statistics for you. This one's from Accenture in 2019. 68% of business leaders feel this cybersecurity risk is increasing. So what does that mean, and why should we care? All right, so what is it that is a cybersecurity risk? And if we look, what that means to most people is getting hacked. And to just show you something about the scale of what that actually means, we've got a really alarming statistic coming up from the University of Maryland, which says that there's a hacker attack every 39 seconds, which means that if we hang around here long enough and we just hold our breath for a little while, that someone in the room will probably be hacked. So hackers look like this, right? And the trouble is this is what's in the news, this is what's in popular culture, this is what's in the media, this is what you expect a hacker to look like. But what I'm here to tell you is that not everybody looks like that. I said at the beginning, I am the people hacker. I don't work with computers or necessarily with tech, but I am a hacker. Now, when I talk to people and say I work with people, so a people hacker, they imagine something like this. Obviously, I'm not this either. I'm not an axe murderer either. But what I do is I simulate attacks on businesses. So I simulate hacking attacks on businesses, on individuals, in order to protect them. So can you imagine where you say to someone, I'm a people hacker, we simulate attacks? They think I do something like this. And the truth is, sometimes we do, okay? So sometimes we do break into physical buildings, break into organizations. But obviously, I don't look like a hacker, and hopefully I don't look like a burglar, although I might sound like one if you don't like people from Liverpool. It's actually more of a professional operation than that. We put together a team, if only my team look like this, and we actually launch an attack on an organization. And the idea is we can exploit all the security vulnerabilities, and then when the bad guys try it in person, the weakest link in their organization has been patched. But I want you to understand what the weakest link in an organization is, because the security press absolutely concur with what I do for a living. In security, what we know is that human beings are the weakest link in any security posture for an organization. And it's constantly reinforced by the press in my industry. The weakest link for an organization is people. And really what that means is that someone who attacks people, is a people hacker, doesn't need to be able to get through the tech or anything else to get to you, because people will always let me in. Let me explain. So although I am a social engineer, so someone who uses people to get through security, there are lots of other types of social engineers out there. And unfortunately, most of them are malicious. So what type of people are they? Well, we can look for the absolutely stereotypical computer hacker. So this would be the image that most of you would see. It's usually a young male wearing a black hoodie, sitting behind a computer, probably without many mates, and trying to get into an organization's network through technical means. Now, even technical hackers use some element of social engineering, because we've got to incentivize somebody to click on a link or open an attachment. But it's more than that. It's not just hackers that you'd imagine. It's special interest groups like Anonymous. You see here in all its different flavors, Anonymous is actually lots of different special interest groups, but they use social engineering techniques to crack cybersecurity, as does, unfortunately, organized crime. So I think what a lot of people imagine is that cybersecurity is the lone hacker. It is this sort of very nefarious code, digital thing. But actually, a lot of the scams and frauds and cons that are perpetrated on individuals, on organizations, on businesses are done by these huge multinational organizations, criminal organizations, with banks of people reading these scripts, making the phone calls, sending the emails out that we might be familiar with. And the reason is that it makes an awful lot of money for organized crime. So it is a big business, and it is a very organized business. And then what we have, which is perhaps the biggest growing area in my organization, is the idea of insider threat. So that is the person who works inside an organization who, through mistake or malice or mischief, 3 different things, might be converted into working against the organization by an external malicious actor. So what a social engineer is always looking to do is get someone on the inside to metaphorically or actually open the gates for them and give us access to everything. Remember that if I can get someone who works for you inside your organization to give me what I need, then I really don't need to be a technical expert. And everyone's vulnerable to it because everyone has pressure points, everyone has levers. But the thing that you might be familiar with, and the statistic that might really surprise you, is that 91% of all of these attacks actually launch not with some nefarious attack coming from sort of the cloud, the web. It starts with phishing emails. And that's because it has to interact with a human. And if you can interact with a human, you can get them to click on the link. So all of those emails that you get that are designed to get you to click on these bad links or open these bad attachments or take you to a fake site are written by social engineers, because it's written to compel you to do whatever action the criminal wants you to do. And unfortunately, it's not just emails. Increasingly, what we see is something that we call smishing. So it's all the ishings in security. And smishing is when we get a text message, and the text message contains a link or a number. And again, it's written by a social engineer to incentivize you to click on that link. And it's very, very difficult for people to ignore it when it's a text message. I think people don't think so much of their phone as a computer in the same way that they might think of their laptop as a computer, and therefore they just click away. We put less protection in terms of antivirus software and everything else on our smartphones, but it's every inch a computer, just in the same way that your laptop is. So smishing emails, fake texts, hugely growing area of fraud and written by social engineers. And then there's the good old-fashioned telephone. You get that call. The call maybe mentions money, it talks to you about something that you need to do, something that you should be doing. We've seen so much of this in the recent pandemic. People getting these phone calls, people pretending to be banks, pretending to be financial institutions, pretending to be the police, the track and trace app. And what that call is doing, and we call this one vishing, so another ishing, all of the ishings, voice phishing. It's looking to get details off the victim at the end of the phone so they can exploit that and turn that person into a victim, steal their money, their identity, etc. Social engineers also even do physical infiltration. This was my specialty really before the pandemic. And these were the people who follow people into buildings and offices and effectively perform burglaries, steal information physically on the site. So whether it's something that's after your credit card details, your identity, whether it's a form of ransomware, which is when your computer is locked, your files are encrypted, and the criminal asks you to pay something in order for you to get those back, or whether it's collecting your credentials for a fake streaming site, which again we saw very strongly throughout this 2020 COVID year. Fake websites, people are at home, they want to watch movies and TV more, and those websites collect your credit card or bank details, your address, your name, and then use those to exploit you, whether it's password harvesting or anything else that you might imagine or label a cyber attack. Up to 95% of the breaches that we hear about are all due to human error. That's human mistake or manipulation. So what I do for a living as a people hacker is actually huge. It's actually the biggest way in, and it's not particularly technical. It takes huge amounts of money off organizations. So whether it's the cash, whether it's the data, or your information that you want to protect from going public and being public, it's social engineers that are behind it. And just know that this is huge business. The average cost of a data breach in 2020, we know, will exceed $150 million. This is really worth it as a criminal enterprise. And we also know that in the first half of 2019, and obviously pandemic, we're still compiling stats for most of 2020, but it was 4.1 billion records in the first half of 2019. So you can see how big a business this is. Now, one of the problems is people think there has to be a large organization to be hit by this type of attack. But the truth is, large organizations are absolutely at risk, but small companies, SMBs, individuals are at risk as well. Remember that if I can go into a small organization, they are a route back to the larger companies. 12 people, 100 people in a little company, easier for me to track, easier for me to profile, and easier for me to smash. So small companies account for about 43% of cybersecurity attacks. And then there's the individuals, the ordinary man or woman on the street, people who think they are not important enough or rich enough to be the subject of an attack. Is absolutely not true, because the thing is this: all of us are worth hacking. All of us know somebody or have information or have something we wish to keep private that turns us into a juicy target for criminals. And unfortunately, that's why my job is so busy and why there's so many people who do it. What I say is, I don't need to work on the lock, electronic, digital, or otherwise, if I can work on a human being. And that's really the essence of what I do for a living. So what does this mean? Well, it means that I can work on the brain. So I'm looking at getting into someone's psychology and seeing what we can do with that in order to get you to give up data, information, and let us in. And remember, I'm doing this in an ethical way. I'm hired to do this in order to expose these security vulnerabilities, but criminals copy these methods as well. And what it relies on is a number of things. We rely on the fact that psychologically, people have certain behaviors. We follow crowds, for example. We have automatic behavior in the brain. So we know that things like social proof have big effect. If we tell someone everyone else has clicked on a link, they click on the link. We also know people get bored and distracted easily, and perhaps don't look at the right people, are suspicious of the wrong person. After all, as I said at the beginning, I do own a hoodie. I tend not to wear it for work, and I really don't look like a hacker or a burglar. People are curious, and if we can pique someone's curiosity in an email or otherwise, then we can absolutely get through. If we drop USB sticks in the car parks or offices of a potential target, somebody will plug that USB in. If we write confidential on it, they'll plug it in straight away. And if you write payroll or salary, that will be the first thing they'll do. They'll stop everything else. So human curiosity is the problem as well, as is distracting. We see in romance scams and other things that it's easy to get someone off topic, focusing on something else, and we can sneak in the malware or whatever we need to do somewhere else. And one of the real issues that we have with this is that most people don't think that this is their problem. They don't think that security is their issue if they don't have security in the title. I want you to think of, who do you think of when you think of a security breach? Who do you believe should handle it and protect against it? It's not usually yourself and your staff. But if social engineers absolutely target individuals, then it's individuals that need to protect themselves against social engineering. For example, most social engineers use emotions and emotional temperature in order to get people to do what they want to do. When we become emotional in any way, shape, or form, logic is kicked off the cliff. And emotions can be angry, happy, sad, frightened, any number of things. So what a fraudster, a scammer, a social engineer is looking to do is to raise your emotion to get you to do what they need. Let's look at fear, for example. Fear, like every emotion, is on a scale. We can go from being madly worried to being absolutely terrified. But if we can invoke that through an email or a call, then that person will be looking for a way out of fear, and that's when we step in. So that's everything from letters or emails that say, you've been caught speeding, you haven't paid this fine. And people are worried for a little minute and they look and they click on the attachment out of curiosity and fear that they've done something wrong. Now, fear doesn't work, greed will. We very often use greed, the promise of reward, for example, to capture people and to make sure that they do what we say. We very often pretend to be, for example, a headhunter on the phone, and we'll talk and we'll call someone. I might say something like, hi, my name is Simone and I'm calling you from this headhunting company. And we have this fantastic position that pays like £1 million and you work on Tuesday mornings, but with supermodels. And would you like it? Are you interested? And what we find is that even if that person is happy in their job, they're curious as to know what the name of the company is and what the exact package is. And I'll say to them, look, we can do that, but you need to sign an NDA. Can you do that? And we send them the NDA and they click on it. And when they click on, we've access not only to their device, but to their whole network. The reward doesn't have to be big. If we send people emails with links for a free coffee, they'll click on the link for the free coffee, assuming that the reward is small and therefore the risk is small. And coming up to this time of year, we've got everything from Black Friday sales and fake emails about shopping and bargains to things like praise and flattery, of which I'm going to talk to you a little bit more later. We also can use emotions like anger. A funny example was calling an organisation at one point and saying to them that the Wi-Fi was about to go down and that they had about 5 minutes just to save all their work and to switch networks before they lost their connection. Everyone was furious. We put a fake number in so they could ring in their complaints. They all switched to that fake new Wi-Fi because they didn't want to lose their work. Of 267 people in that organisation that we emailed, 264 clicked on the email and the other 3 were outside at the time I was watching them. So we're talking about what goes on in people's brains and how we hack the brains. And as I said before, phishing is the biggest attack vector that we have. 94% of malware is delivered by email. But how does it happen? How do we get someone to click on a link? How can we be so sure that you will do it? And the answer is social media. These days, everything that we do is online. And what criminals are doing is they're building a picture of your life and of you, and they're building that picture so that when that email comes into you, when that attack happens, it's very targeted, it's very believable, it's familiar to you. So it hits its target very carefully. And we know that most of the hacking groups and attacking groups that are out there use what we call spear phishing, which is that personalized phishing email. So not the general one that asks for bank details, but the one that says, hello, John Smith. This is, remember, we know that you're interested in golf, so it'll be about golf. It's that really makes it so efficient. And the problem is we put everything online. So whether you put your exercise routes and your running on apps like Strava, whether we know where we eat, and maybe do reviews on TripAdvisor, our work, our offices, posting photographs of team exercises or inside buildings with details on whiteboards or lanyards in the back. We put everything online, our family, our fears, what we care about, what frightens us. Every single person, life is online. And that means every single person is a potential target. Every single person can be traced. There is things online that you do not even have to be on social media for all your details to be out there. And the reason that I say that is I think a lot of people say, particularly in an audience like this, might think, well, I don't really use social media that much. I'm not really on Facebook. I don't really post on maybe Instagram. But we're all so connected these days. And I just want to leave you with an example of a client of mine. I call him Moby Dick or Mr. Big because he wasn't online either. And he was an old-fashioned kind of guy. He didn't really use the internet very much. He certainly didn't use social media very much. And all I really knew was his name and his organisation. But his security team had asked me to get him to talk about his jobs, his strategy, and his diary. They wanted me to try and break into his office and try and access his phone. Easy. So I look for him and I can't find him on social media, right? So Moby Dick, Mr. Big, he is on social media. He doesn't post anything on there. He's not the type of guy that posts stuff on the internet. But as I'm sure many people who are listening to this are in the same case or in the same boat, he does have directorships and non-executive directorships, which have got to be on Companies House. And from Companies House, I can find out a lot about it. I can also find out from 192 in this case, because he had not a doubt where he lives. To get to Mr. Big, I look for his address and I see who he shares it with. He shared it with the fourth Mrs. Moby Dick, who did not look like that. I find out some of his companies and his directorships on Companies House, and I find that he has Company A, Company B as a director, but he also supports a charity. Let's call it Save the Whale. That's not what it was called. It's also supported by Mrs. Moby Dick. I go to the charity website and blah, 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 blah. It says lots of different things. But the thing that I notice is that there's many fundraising events planned in the near future. So to get to Moby Dick, I decide to get to Mrs. Moby Dick. I give a small donation to their charity and buy some tickets for the next event. We rock up in the hotel, not that hotel, just a stock picture. We rock up at this hotel. I put a microphone in his face and I start to interview the two of them about this charity. They give me some information, but the next day when I play the tapes back, wouldn't you know it, those tapes didn't work out. So I call actually his secretary and I say, look, we had this great interview. Everything went really well. But what I need now is to do a bigger interview, maybe take a photograph, praise and flattery, put you on the front page of our magazine, and just so we can see what type of magazine that we are. Here's the link to our previous issues. If it doesn't work, don't worry, we're having some issues with the tech. We rock up in the office. I put a mic in his face. I ask him a few questions. They asked if he wanted tea or coffee and when to get us it. And by the time they get back to the office, we got into their laptop, we got into their phone, whose PIN code I'd looked at over his shoulder in the hotel. And by the time they got back, we'd gone and they'd been hacked. You see, the problem is this. Your shield absolutely needs to be up for social engineering. But for most people, you don't even know it exists. Most businesses and organisations think they can't be caught. You've got to put that shield back up. Otherwise, you might as well be wide open. You are connected to people who would exploit you because people that you know. You are only as safe as your most chatty relative, teenagers, kids, the most talkative person in your office or network, the most connected person in your business. It all leads back to you. And you can be researched and you can be scammed and you will be a target no matter what, how important or how rich you are or you're not. So 62% of businesses reported social engineering or phishing attacks in 2019. This is 2020. We already know that those figures are much, much higher this year. And that, of course, coronavirus and COVID are being woven into the narrative for criminals using this type of attack. I want you to tell you that the security industry, Kevin Mitnick is one of the most famous hackers in the security industry, and he was hacking a long time ago before computers. And he said there is no patch for human stupidity. It's his opinion that we will always get past because people like you don't know about these attacks until today and will never ever protect themselves against them because people don't think they can be fooled. My opinion, are people the weakest link? Well, I don't know. Most of the time, if we're really determined, we can get through. But if you're aware of it, like you are now, and if you protect yourself quite a bit, you can make yourself a more difficult target. There are organisations out there that will tell you the people are the strongest defence. And I think that's true some of the time. I don't think we're the weakest link or the strongest defence. I think mostly we're just human. And I think that will be our downfall. But I also think it's your one shot at protecting against this, your one shot at salvation. I'm going to leave you with a quote. Gabriel Garcia Marquez said, all human beings have three lives. You have a public, a private, and a secret life. I'd ask you to listen to what I've said today and keep it that way. Thank you for listening.
Jenny, that was fantastic. Thank you.
You.
That was really, really good. Much appreciated. So, and just for shareholders' information, really, Albion does a lot of work within the cybersecurity field, and three of our most successful companies Egress, Quantexa, and Panacea, as well as some new ones are heavily involved in that area. So Jenny, just to reassure you, I personally, and I'm sure most of the people on the call, really like people from Liverpool. So let you.
No.
least we can say. Okay, so we got 1 or 2 questions for you, Jenny. So if it's okay, I'll give you 3. Now the first one, I'm not entirely sure whether it's a misprint or not. What software can you add to iPhones to screen for smishing? Do you mean smishing or?
Smishing. So yes, it's smishing. So they're the text messages. So basically we can insert a message into a text thread that you're having with friends, family or colleagues that's a bogus message, as well as just sending bogus messages. In terms of software, you need to sort of look, there's a massive range out there, and you need to look at the type of software and anti-malware that you put onto email and get that on the phone as well. So what you have to think about is your smartphone is just another laptop, and you have to install the same technology onto that. And there's a huge range of them. I wouldn't endorse anyone in particular, but there's lots. It doesn't take a huge Google search to find the right stuff.
Great, thank you. The next one is, what are your 3 brief top tips to help us avoid being hacked?
So there's a couple of things you can do. First thing, any apps that you're on at all, so any websites, if you're on LinkedIn, particularly thinking of a professional audience, but any social media, you need to check your privacy settings and make sure that you make a choice as what you're sharing. So we're not saying don't use them, but you do have to make an active choice as to who can see whatever you put out there. And I'd be very careful about what you put online, because even something as simple as saying that you were a fan of a particular type of wine or a particular sport is enough for us to construct that email that's very compelling and get people to click. So be careful of what you put online and check who can see it. And I think obviously don't click on links and attachments unless you're sure you know who they're from. But the one thing that a lot of people don't do is they don't update the apps on their smartphones and computers. So you'll see on your screen, it'll say, please update. And it's difficult, it takes a bit of time and you lose functionality whilst it's updating. Make sure that you always update those apps, because most of those updates are security updates. And once a gap in security for a particular app or a particular website is identified, then that is made public very often. And that means until you update the app, there's a hole, if you like, in the security that people are actively pursuing and trying to get through. So update the apps, update your privacy, make a choice, careful what you put online, and don't click on links or attachments. And those are only basic, but they're the things that people forget to do that protects the most.
Thanks, Jenny. The last question is slightly cheekier than we normally get from the usually very well-behaved Albion shareholders.
Right.
How many times have you been arrested?
Oh, now, you see, that's a question. I get asked that question all the time when people realize I'm a burglar. And I'd say I'm not telling, but there'll be a book out next year that you can read and find out all about it. Commercial break.
Okay, so we'll leave it to our imagination. Okay, Jenny, thank you. That was absolutely brilliant and much appreciated. So now I'm going to go and pass you on to our healthcare panel, where clearly Albion does a lot of work as well, chaired by Pam Garside, with Andrew Elder, and 3 of our investee company chief executives.
Thank you, and hello and welcome to this health technology panel session. The title is Health Technologies, How They Help COVID, the NHS and Future Trends. I'm Dr. Andrew Elder, and together with my colleague, Dr. Christoph Rudig, we oversee healthcare investing at Albion. Albion has been investing in healthcare for over 24 years and in health technologies for 15 years, and currently has one of the most diverse healthcare portfolios in the UK. I'm very pleased to be joined by a panel of very preeminent health technology experts drawn from across the Albion portfolio. But before I hand over to them, just a few words on why we think health tech is such a good place to be investing at the moment. The opportunity in healthcare is vast, and the digital journey is really only just beginning. There's a huge untapped opportunity in play, with only 3% of current healthcare spend in the digital sector. that's massively lagging other sectors. And the direction of travel is only going one way. It's driven by powerful forces that are not slowing down anytime soon. The demand continues to grow and costs rise faster. There's increasing recognition that patients need to be at the center of care models rather than healthcare practitioners. People increasingly are willing to pay for and demand high quality, convenient services. And that consumer mindset, coupled with our ability now to focus increasingly at the personal level, driven by new technologies, is driving a disaggregation of patient populations. Each person is treated as an individual, not as a disease type. And all in the context of an ever digitizing world. Healthcare is a laggard sector, but it really can't remain isolated forever. And COVID has hit the turbo boost for most of these drivers. We've seen escalating costs in the recent pandemic, need to diagnose quickly, people and patients at the center, and rapid discovery of treatments required, all at an unprecedented level. Global collaboration and data sharing, remote clinical trials, and the list goes on. But the only way to manage these forces is through the adoption of new technologies. And these might be software or hardware or biotechnologies or a combination of any of them. Software is required to gather, handle, and make sense of this explosion of data. And we use machine learning to deliver accelerated insights. And use of the cloud makes software-driven solutions affordable and accessible, enabling new business models and care delivery models. And in a world where the patient or consumer is becoming central, engaging them is key. And software is the only way to do that at scale. We've got access to increasingly low-cost hardware and biotech, which enables us to have new ways of diagnosing, treating, and monitoring diseases in an ever more precise and personalized way. And so, in short, health technology is now a must-have to enhance the way we deliver healthcare. So what health technologies are we investing in at Albion? Next slide, please. As you can see, Albion's funds are well exposed to opportunities in both areas. The companies on the left typically sell to pharma companies and provide software solutions to pharma companies to engage with their patients and gather or access patient data. Whereas the companies on the right typically sell to healthcare provider systems or payers and deliver care either directly to patients or provide diagnostics or digital support services to health systems. They're all performing well, and we expect the next 5 to 10 years for health tech to continue to outperform. So let's now speak to some of the people on the front line to understand some of the reasons why. And so I'd like to hand over to Pam Garside, who will introduce our panel and lead the discussion. Pam is one of the best known people in UK healthcare. She won't admit that, but she really is right at the center of health technologies. She's also a member of our Crown Place VCT that we are privileged to manage. And she's an angel investor in the health technology sector and works with Cambridge University on their spin-outs. Pam, over to you to introduce the panel.
Thank you. Thanks, Andrew. I just wanted to say a few things before we introduce our great panel. Digital health was in the ascendant even before the pandemic, but COVID has accelerated its deployment in both treatment and prevention, and basically has had a massive impact on the health system, not just in the UK. With the rapid uptake of digital technology in care delivery, an example is video consultations in primary care in the UK were 25% GPs on video, now it's over 70%. And as we've seen this week, unprecedented activity in the development of treatment and vaccines and diagnostics, and massive global collaboration in pharma and biotech and universities and governments, which is terrific. And the other thing we've seen a lot of in the last few months is significant growth in investment into the digital health sector, which Albion, as Andrew pointed out, has been doing for years. So it's great to introduce our panel. All three individuals are involved in Albion companies. Ahmed is a practicing clinician and co-founder of Locum's Nest, a company providing a total workforce solution that empowers flexible working for the NHS. Hi, Ahmed. Chris Brinsmead is a hugely experienced former CEO in the pharma industry. He was president of AstraZeneca UK some years ago, and he now chairs multiple companies, including Preveka, one of our portfolio companies, which develops medicines for children. And finally, Rich, who's founder and CEO of Helios, a digital mental health company, and he has a 20-year career before that in the healthcare industry, working for pharma companies. So welcome, all of you. I'm just going to kick off with a question, but hopefully we'll have some to and fro as well. So the opening question is, Chris, I'll start with you. Tell us about the most innovative ways you've seen technology impact the response to the current pandemic in your area of pharma.
That's a great question, Pam. I think that I spoke to one of the people in the companies who leads the marketing efforts and said, what's changed in the last 6-9 months? And she said, everything's gone digital. So on the downside, which I think will come back a bit, face-to-face has virtually disappeared. I'm talking about people talking to people, meeting physicians, working with healthcare providers. But digital has exploded. And some of the stats on that, if you look at congresses, if you look at conferences, all of the things where you'd see typically a lot of face-to-face, the increase in attendance has gone from, say, 30% increase to a 10-fold increase. So massive, massive switch. It's not as easy for companies to get sticky with customers, and companies are learning how to do digital, but there's been a huge shift in terms of what people are doing and how they're interacting. And that's probably the thing that I would highlight as being the biggest positive change. It was already happening, like you mentioned, the GP consultations, but the acceleration in the last 9 months has been unprecedented, I would say.
And this is across all pharma and life science companies?
I suspect it's across all sectors, but across most pharma companies that I deal with, and I was on the board of UDG, which is a pharma services company, we've just seen all the pharma companies switch massive resources to digital to learn how to better interact with people via social media, via the web, because the face-to-face opportunity has really disappeared.
Yeah. Thank you. Ahmed, from your point of view, what's your sort of response to that?
No, hi Pam, great to see you again. So for us, we've tried to basically provide a service where we'd ensure that the right doctor, nurse, pharmacist would end up at the right place at the right time where they were most needed within the NHS. Well, one thing that struck us was, data is rapidly changing. The NHS is historically not very good at managing it. But what we do know is once somebody is diagnosed with COVID, 4 to 5 days later, they will become acutely unwell if they're susceptible to it. And a few days after that, they will end up in the intensive care unit if the disease becomes more and more aggressive. Now, before this, though, there was no way of hospitals to kind of preempt that or forecast that, and they'd find themselves always chasing their tails to find the right doctors and nurses to fill their wards to ensure that they had safe staffing. What we've done very quickly is, we link in Public Health England data to workforce data in the NHS. So when there is a spike within a certain area, we will inform that hospital to, call in another 2 or 3 physicians, call in another 6 nursing staff, intensive care nurses, etc. So we're kind of taking the fight to the virus and not vice versa. That in turn has helped kind of adoption of locums nurse across the NHS, but it's kind of doing what's right for them first.
And I have a question. I should first say I'm a massive supporter of the NHS, partly because I've worked in America for a long time. So I'm about to say something slightly rude. Is the NHS ready to adopt you? When you go with your solution that's clearly the right one, have you found that they're ready to adopt?
COVID has almost forced them to be ready. I think cultural change has been the biggest barrier of entry of digital technology in the NHS up until now. I think, this crisis, this pandemic has not opened the doors, but it's made people realize that the way we used to work isn't fit for purpose to deal with this. We just don't have the capacity, so we have to work smarter.
Yeah. So you find it's pushing on an open door, really?
Yes, it's increasingly easy. I think our challenge now is just to support as many trusts as possible, maintain that service and go beyond the pandemic and shift our focus to, after this winter, how do we help the NHS open up its elective surgery? How do we help with capacity outside of just acute medicine, that's something that we're planning for already.
I'm going to come back to that. Rich, how have you found all this?
Yeah, from our side, and our perspective or our lens through this particular topic is through mental health services and how we're working with the NHS in delivering high quality care. And I think from our kind of experience in seeing what's been happening across mental health services, it's actually been really fascinating on how mental health services have responded during COVID. Because when we think about mental health services pre-COVID, they really were the laggards in adoption of digital solutions in their care pathways. And for some of the reasons that Ahmed as well as highlighted, but there was some traction pre-COVID to adopt technology. But moving into COVID, it really has forced the mental health trusts and the overall mental health system to react in different ways. And one of those ways is how they themselves have rapidly adopted kind of video conferencing tools like Zoom and Teams to enable the continuity of their services to be delivered during COVID, but also how they've really kind of turned to partners like Helios to support their current care pathways and how to continue to deliver safe, effective, accessible and timely services during COVID. So it's been really interesting on how they've also pulled on their kind of strategic partners to deliver effective care. And then also interestingly from an NHS England standpoint, how actually they've really kind of stepped up in this response to really engage with the innovative kind of technology or health tech universe to really put in exciting innovations that can scale very quickly to support what is just a massive impact on the mental health of our society during COVID. And we've been able to support that kind of call to action with one of our solutions, which is Think Ninja for children's mental health, which is freely available across the whole of the UK during the COVID crisis. So it's been really fascinating just to see how the NHS has responded during this time.
And a blunt question, has the NHS spent more money on mental health? Because it's normally the poor relation, as you know better than us. Have they stumped up funding for this and for services like Helios?
So pre-COVID, there was a plan to bring a lot more investment into mental health, because as you rightly said, Pam, it's been underfunded for decades now, and as a result of that, the system is under so much stress at all points of the care pathways. So there's already kind of funding or fresh funding coming into mental health services pre-COVID. We haven't seen that amount change currently during COVID, but what we do know is after every single crisis the world has faced, for example, the 2008-2009 financial crisis, there's this massive aftermath impact on the mental health of society. So we know there's going to be this huge tsunami of mental health challenges coming as we emerge from COVID, which we hope there's going to be more fresh funding to support that.
Yeah, thank you. Chris, can I ask you, this week, clinical trials are in the news, aren't they? How has COVID affected trials and recruitment for clinical trials?
There's a yin and yang to this, Pam. So there's something like 69 active programs in humans for COVID vaccines, which I think illustrates the global pharma industry's power in actually addressing this issue. And the news yesterday of the Pfizer program, I think, which flipped all the stock markets up significantly, was just tremendous news. And I'm sure there will be other vaccines that follow through pretty quickly. So that's the good news. And I think regulators will obviously make sure that these vaccines are safe as well as effective, and I'm sure they will look at them quickly. The yang has been that we've seen regulators slow down. So whether it's a CE mark for medtech or whether it's a drug development program and clinical trials for that, we've seen a slowing down. In some cases, we've seen clinical trials stop. So there have been some positives, the one I mentioned about vaccines. There have also been some negatives in terms of the slowing down of that development of new innovations. I think the other thing, just coming back to what Andrew was saying at the beginning, because everything's going digital and people have realized that, oh, actually Zoom and Teams work, I think people are much more willing to adopt digital technologies to speed up their clinical trials and to speed up regulatory processes. So I think whilst there have been challenges in the pandemic, there's also opened up the door for a lot of opportunity.
Yeah, thank you. So a couple of you have mentioned post-COVID, and just how much of a revolution might the adoption of digital tools be for each of you in the industry, and will it stay? I mean, you've said that already, but will it maintain that interest? I think it will, but in your parts of the industry, will it stay after the pandemic's died down, hopefully next year? Will we maintain this interest and funding in digital? Rich, why don't you go first?
So I think pre-COVID, during COVID, and post-COVID, it's all about how do we fundamentally deliver, exceptional care to the patient and the family, and how do we do that in a timely way, that it has high quality, that it helps them move forward with whatever challenge they're facing. So those kind of principles haven't changed pre-peri and post-COVID. I think what we're facing post-COVID is just the magnitude now of the challenge, and that pressure now that was already kind of we're seeing in transformation pre-COVID, which is that already in today's society, the model of delivery when it comes to mental health services in particular is not fit for today's society. And it's very much about how do we take that current model, which we know is not fit for purpose, and how do we evolve that's right for tomorrow's society. And particularly today, pre-COVID, in this country, already 2/3 of children with a mental health condition were not receiving treatment anyway. We're not able to access children's mental health services in this country. And we know that's going to be so much worse post-COVID. So if anything, this COVID will just further accelerate more and more the need for every single mental health trust and system in this country to really embrace new models of care, because this deluge of need is going to hit their front door, whether it's 3 months post-COVID or whether actually by the time it filters down to the family and the impact on the family when it comes to mental health, it could take 9, 12, even 2 years before we really kind of start tackling the aftermath.
Yeah, and a controversial bit, and it's not controversial actually, that there might be people in our audience today who are waiting for an operation. You can't have an operation digitally. And there will always be a need for a face-to-face consultation in mental health, in surgery, of course. And you accept that, right? And I guess those models have to change as well.
Yeah, so from our side, we embrace that choice agenda, which is very much about every transition point that you as an individual and your family, that you have that choice of going in person and having that care when you need it, but also you have that choice of going digital. And you're right, some aspects of those care pathways, particularly out of mental health care, still have to be done largely in person. But I think it's that kind of point or principle about choice. How do we always enable that family, given their particular circumstance, particular need, that they can have that choice for digital or in person?
Thank you. Ahmed, what do you think? Will we maintain all this interest in services like yours?
I think that there will absolutely be kind of maintained interest, but it goes beyond that. I mean, as you alluded, people that need operations, various surgical procedures, they need to happen in person by definition. And I think in the first wave of the pandemic, it was relatively easy to switch off very selective units. You could switch off your trauma orthopedics, bar your emergency lists, and we got away with it for 2 or 3 months. But we can't afford to do that through wave 2, and if there is a wave 3, people have been waiting for far too long. So for us, and what I think will happen is kind of much deeper partnerships with the independent sector. There is huge capacity in the private healthcare industry, and you've got perfectly capable clinicians, nurses, allied healthcare professionals. So I suspect there'll be a much closer link between the NHS and the private sector in the new year. And it's our job at Locums Nest to make sure that a doctor working with the NHS can support and utilize physical resource in a private hospital and vice versa, and not make them competitive in nature.
That's interesting, right? And anything else that you think might happen when the pandemic dies down?
Sorry,
Chris.
Yeah, go on, Chris.
I was just going to jump in. I mean, I think there will be a wall of hugs when the pandemic dies down, because I think people have missed face-to-face contact. I mean, professionally and personally.
Yeah.
But I think the reality is that this pandemic has accelerated a change to digital and adoption of digital, and that isn't going to go away. I mean, I sit on council at Imperial College, and we've had a massive influx of students and postgrads this year, the biggest increase in about the last 10 years. And we're giving mixed mode of teaching, so we're using digital, and we have labs and we have medical students. I don't think that's going to go away anytime soon. I think what's going to happen in all the sectors is you're going to see the adoption. I mean, it's music to my ears to hear that you can speak to a GP on the phone through FaceTime or go and see them, because that's really how it should be. And I think that the society is going to adopt many of these things as standard practice. But I equally feel that people will want to get back to some face-to-face, because I think we're human beings and we need that.
Yeah. You can tell from my background, I teach. I hate teaching online, but I'd be the first one in line for the wall of hugs. But quite a lot of general practitioners are now saying it's great having video consultations, but you miss the stuff just around the edges. You know, the hand on the door of, I've got this other problem, doctor. But I think we're living with that at the moment. It's how we'll deal with it afterwards, I guess.
Yeah, the only counter I would make is I think GPs in the UK, not in countries like Sweden, but we're quite slow to adopt technology. Yeah. And so this has been an acceleration. You're absolutely right. I don't think you can replace face-to-face for a lot of things, but it has been good and it's accelerated. The UK is one of the slowest countries to adopt innovation in the world. And so in some ways, this has been a good kick for the UK. But if you look around the world, other countries have adopted technology much, much more quickly. Estonia is a great example where all the kids have laptops and iPads. Yeah.
And Chris, what about pharma? I'm guessing the digital revolution will not leave pharma after this pandemic. What about the pharma and life science industry?
I think in pharma, I think you'll see more adoption of digital tools in clinical trials and regulatory processes. I think on the sales and marketing side, you're going to see a massive switch with people trying to work out how do we interact with healthcare professionals through other means than just face-to-face. So I think pharma will be massively changed by what's happened. And many of the things in a good way, but I still think the face-to-face bit will come back, because in the end, I think people value that and will need that, much like a doctor needs that with a patient from time to time. I think you do need that for other interactions.
Yeah.
And Chris, just out of interest, do you feel that the time frame between developing a drug to bringing it to market, do you think it will be dramatically kind of shortened with digital, or not really have much of an impact?
I mean, it's the holy grail. Everybody would like to shorten the timescale, because if you can, and I mean, what Pfizer have done with this vaccine is unbelievable. I mean, it is quite incredible that I suspect the program didn't exist a year ago. So it's possible for the timescales to shorten and for digital to speed them up. So I think, yes, they will shorten a bit, but I don't think you will see anything like the magnitude of shortening that we've seen with the vaccines for other medicines. I think, sadly, it just takes time to develop medicines through the process.
Mm. And is there other sort of savings that the pharma industry will kind of have from kind of more digital orientated trials? Because we know the phase 3 program is the most expensive phase of drug development. And do you see that cost coming down a lot with new innovations and trial design and management of trials?
Well, if nothing else, I think every company in the world saved a fortune on entertaining and traveling expenses for the last 6 months. So I think there will be some savings. It's hard to predict whether they will stay and whether companies will adopt some of these changes. But I mean, pharma companies are about developing treatments to cure diseases that haven't been cured, and so they will find the best ways to do that in a safe and effective manner. So if digital helps them do that more quickly, then I would see pharma companies adopting some of these tools.
And will it become more global, Chris? Because we can do anything on Zoom globally. I mean, you can't take the sample.
Well, pharma has been global for 40, 50 years. I mean, you can't spend billions on drug development unless it's done globally. And I think all the pandemics, pharma has played a role in, whether it was SARS, whether it was AIDS, it doesn't matter what it is. Pharma has played a role. And the only way you can fund it is to do it globally, because it's just too expensive for anyone to do on a national or even a regional basis. So I think the reality is that and the wonderful thing about digital is it is global. So
yeah,
we're having a call here. I don't know who all the people watching are, but they could be in Japan, they could be in America. So I think the reality is one of the things this pandemic will push is more globalization, even if it is via Zoom or via digital. But pharma has to be global. It's just too big a nut to crack.
Yeah. So final question, Ahmed, what would you like to see happen in the next year? Is it from the NHS or that would help, let's say, help your business?
Yeah, so it would just be openness to keep trying new things, which we've seen them do already over the past 6 months. The next phase, it's not going to be, a big and scary virus that's going to be causing the problems. It's going to be, a massive backlog of between 5 to 10 million people who need procedures and clinics and various other healthcare interventions. That is as big a problem, if not bigger, than the current issue that we're facing. So I just hope that willingness to adopt new platforms and the openness to a kind of a culture change remains. Yeah. I'm confident it will, based on current conversations and relationships, but the NHS is a big place. So that's it.
Thank you. How about you, Rich? What would you want to happen the next year?
So, what ideally I would like the NHS to kind of embrace, and is really to believe in themselves that rapid kind of digital transformation is possible based on the COVID experience, and to kind of really take that and run with that as fast as possible. Because when I think about the NHS long-term plan, and again through my perspective here of mental health services, the target is in 10 years to treat 1 million children a year for their mental health condition. Today we're only treating 1/3. And what I'd like to see in the next year is actually the NHS saying, actually, we can do a lot more if we embrace technology and reach that goal a lot sooner. Let's make sure that we don't have a generation of children go by where their mental health is untreated. And let's try and shrink that down. And that's what I want them to just embrace and take all that energy from this COVID scenario and believe, actually, this is possible to do if we really embrace it.
Thank you. And finally, Chris, what would you like to happen generally in your sector of the industry?
Well, I think Ahmed and Richard have already said, I think the openness of healthcare systems and people and organizations to change and to adopting innovation is the single thing that would actually make the most difference, whether it's mental health, whether it's development of a medicine. It doesn't really matter what it is. I think people need to be more open-minded and need to be willing to adopt innovation and accept that not all innovation will work, that you might try some things and it doesn't work well, so you have to change it. But I think it is that change of mindset that will be the single thing, and that will be global, not just the UK, but that would really be globally. If people were more open-minded, and I'm not talking about taking unnecessary risks, I'm not talking about cutting corners, I'm just talking about being open to the adoption of innovation, whatever that is, and then trying it. There's a fantastic book called Black Box Thinking by Matthew Syed. I would encourage everybody to read it. It's about open systems, and I think if people had that mindset, then we would be able to move much more quickly with some of the challenges we've spoken about.
Yeah. Well, thank you. Terrific panel. Thank you, all of you. I think it's very interesting that it massively exciting times. We've seen a big wave of change, and you're saying we should keep using that momentum. Very interesting about the care models. I have to say the medical profession isn't always the first to adopt care models. Ahmed, you know that. But these need to change, and a couple of you said we need the cultural change that goes along with that. I love Chris's comments about yin and yang, because there's always positive, but there's sort of balancing negative to watch. And I would say get your kids to go into digital. There's a lot of jobs in this, in both sectors. So thank you, all of you. And I'm going to hand back to Andrew.
Well, thank you, Pam, and thank you to the panel. That's all music to my ears, certainly. And we've been investing in both care services and technologies for a long time now. And there's clearly big challenges ahead, but these are the technologies which can make such a difference. So we absolutely hope and expect these technologies to carry on making a big difference over the next 5 years. And we want to be central to helping some of those technologies get through to market and have the impact that we all hope and believe that they can. So thank you very much to the panel, to Ahmed, Chris, and Rich for your fantastic insight, and Pam for sharing such a great discussion. And back to you, Patrick.
Great, Andrew, thank you. And again, thank you to Pam and to Ahmed and to Chris and to Richard. Really interesting, thought-provoking discussion. And it's interesting seeing how many questions are pinging up on the Q&A button at the bottom. So Andrew, you'll be quite busy at the Q&A section. But now I'm going to pass you all over to Will Fraser-Allen, Managing Partner. Thank you.
Brilliant, Patrick, thank you very much indeed. Just for those of you who don't know me, I'm Will Fraser-Allen. I am the Managing Partner of Albion. I have the privilege of leading a fantastic team at Albion. A lot of very, very bright, very smart people who work very hard to deliver the VCT performance that I'm about to describe to you. And we as a team are indeed very privileged to be managing your money, and it's our job to provide you with decent returns over the mid to long term. And what I'd like to do today is to tell you a bit about that. If I could have the next slide, that'd be great. Brilliant. So in terms of what I'm going to look at, I've alluded to the teams. I want to just bring you up to speed on the team. I'm going to just touch on what it's been like in lockdown and how we've sort of kept ourselves cheerful. Then really moving into my sort of school report, if you like, and looking at the performance of the funds over the period. And I will touch on some of the companies in the portfolio. I know everybody likes to hear about the new and exciting investments that we're investing in, so I'll touch on a few of those. Pick up those exits we've had where we've sold businesses in the year. Moving on to some thoughts on the prospects going forward. Not an easy one in these times, but certainly give you my current thinking on that. Touching on some changes of dividends, bit on communications, and I will go back to fraud to try and just pick up some of the points that Jenny gave us in her incredibly useful presentation earlier. Next slide, please. So, quick reminder of the Albion Group. VCTs are very much at the core of what we do. We have 6 VCTs, about 450 million. But alongside that is lots of deep sector knowledge, which has allowed us to invest in other areas that can no longer be invested in VCTs. So we run institutional money in places like university spin-outs through our relationship, our very deep relationship with UCL. We run two tech funds for them. We've got a renewable energy fund, Albion Community Power. We have the Albion Real Assets Fund that does a lot of asset-based investing. And finally, we are an operator of a number of care homes, both within VCTs and within Albion Care Communities. And we also have Olim, which is our quoted equity investment management business, which invests in UK equities on behalf of individuals, charities, and indeed an investment trust. So the business has a total of about 975 million under management, and we're a team of about 43 people now. Next slide, please. The team is crucial, and we look to invest in the team by bringing in new people, building the knowledge base to make sure that we've got that deep sector expertise, as you've just seen demonstrated in that excellent healthcare talk. But the core sort of areas are certainly on the asset-based side, particularly renewable energy, but also the healthcare team and the tech team are becoming a critical part of delivering the investment portfolio that is within the VCTs. Next slide, please. couple of new hires I'd like to mention to you. Katia has joined the tech team. She's a marketing specialist, and this is very much a decision to invest in the whole area of promoting what Albion does in terms of backing really exciting entrepreneurial businesses. It's all about getting the name Albion out there, so that the really successful and critically important to us entrepreneurs know we're here, and that we can therefore provide critical investment to their companies. Jane is also joining us. Jane is a talent specialist. By that, think a people specialist. So she has had 20 years in senior headhunting and advising on how to develop talent, by which we mean developing teams, particularly management teams. She joins us really to improve our capability in two areas. One is to help us assess management teams, to understand better how we can support them post-investment. And then once we are invested in these businesses, she can work with those management teams to help them in their recruitment process, so recruiting their teams. And people are everything. Absolutely critical to delivering great outcomes and growing fantastic businesses is the team that's recruited to do that. So we hope by bringing Jane on board, we considerably increase our capability in supporting our investee companies as they build those teams out. Next slide, please. So lots has been said already today about COVID, about lockdown. Patrick, in his opening remarks, highlighted that we did make the transition to lockdown very smoothly. We were fortunate we had some very strong IT infrastructure in place, having over the last 18 months particularly invested in a completely cloud infrastructure, which meant that actually people were up and operating really very quickly indeed. And you know, what has been described so many times as unprecedented is in reality becoming a new normal. But just as important as being able to have the technology to work with, it was really important that we stayed cheerful. And picking up the comments about mental health that Richard made in the last panel, you know, we did work really hard to support each other. And what we've got here is an example of it's actually a book we produced, which was based on a photography competition that we held, where we asked everybody to take a photograph of what encapsulated lockdown to them, and these were the three winners. So we've got our I won't go through all of them, but you can see Victoria in the top left is our head of marketing. You know, to her it was just being surrounded by a sea of technology, but having a glass of Pimm's to keep herself cheerful. So we had a lot of fun doing that. Inevitably 2020 has been a tricky year. I've described it more than once as a challenging vintage, but it's one that we are getting through, and we look forward with optimism, not least of which the Pfizer vaccine, which gives us cause for hope, as well as many other vaccines following that. Next slide, please. Few more of the very entertaining photographs that we had as people sort of reflected on what they were doing. Next slide, please. Technology is amazing. It has allowed us to operate from all over the place. So on the left, you see that our team were all over the UK. But as things loosened up a bit over August, I'm very conscious that people have had really quite a tough few months, sort of working sometimes in quite less than ideal environments. A number of people did work from overseas locations, so we've put a few of them up here, even as far away as Australia. Next slide, please. So, what's the impact been of COVID on the portfolio? We did enter the end of March, and as when lockdown was announced, and into April with some concern, as indeed a concern shared by many in the UK. So we were concerned that there would be a big impact, and clearly there have been impacts. But the Albion portfolios have done what they were designed to do. They were designed to be all-weather portfolios through being well diversified across sectors, and importantly, and this has been important, making sure that we were not too exposed to those sectors that one would expect to be more affected by economic cycles. So our exposure to consumer facing businesses was relatively low indeed, and that has stood us in good stead. So the core areas we've invested in, B2B software, has been very resilient, and we do talk about the resilient growth of the portfolio, as many businesses have built up their IT infrastructure very rapidly to support remote working. You've heard from Andrew the importance of our healthcare portfolio, and the opportunities that COVID have presented to those businesses within our portfolios. We have an exposure to renewable energy, as many of you know. The good thing about renewable energy is they have still continued to generate electricity despite all the madness going on around them, and have proved to be both stable and almost totally unaffected. So what does that actually mean in real numbers? It means that when we look at the VCTs on average across the 6 months to 30th of June, so that takes in the sort of pre-COVID levels through COVID, and then the most recent numbers that I'm able to discuss today that have been fully announced. So the total fall was 3.7%. Clearly, I don't like reporting to you falls, but equally well, I hope you will join me in being very pleased with that result, given just what has gone on around us in that period, and those VCTs that have reported their September numbers are showing further moves forward from there. That performance, just to give you some sort of benchmark, although is that the FTSE all share fell by some 17.5% over that period. Although it is important to note that post the announcement of the Pfizer vaccine, there has been a jump back up in the markets, but they're still significantly below the pre-lockdown levels. Next slide, please. 5-year performance to give you a sense of how your investments have portfolio. So this is looking at the average across all of our 6 VCTs. So we've delivered 6.8% per annum over those 5 years, and that is a net return. So it doesn't take into account any tax relief, but does take into account all other costs. So that is what's been delivered to you as shareholders. We've continued to pay very significant levels of dividends, whilst maintaining an important important service to shareholders, which is buying back some 32 million pounds worth of stock over that period. We've continued to invest 27 companies, 50 million invested since July 2019, and indeed since the beginning of lockdown, we've still been able to continue to invest. I'd like to tell you about some of those companies shortly, and we've delivered a number of exits. It's all very well making new investments, but we need a healthy portfolio. We need to be selling our businesses as well, and in that same period since July 19, we sold seven of our investee companies for total proceeds of 70 million. Next slide, please. Breaking down the track record by fund, but also looking at some other timeframes. So the 3 years, the annual return has been 7.3%, and that reflects some strong performance in recent years as our technology portfolio has been maturing. The 5-year we've talked about in the previous slide, but over a 10-year, I'm very pleased to see a 5.9% per annum return, and our sort of underlying target is to deliver at least 5%. So to be able to report returns in excess of that over a 10-year period I'm very pleased to be able to do. Next slide, please. This is a table produced by Martin Churchill, who is a commentator on the VCT sector. Now this is the only table I was able to find that was reasonably up to date, and it doesn't cover every VCT manager. It covers those managers that he was anticipating would raise money in the current period. But I'll leave you to digest these numbers. But I'm very pleased to see that our returns are particularly good over 3 and 5 years relative to our peers. But even but also on the 10-year, we're looking good as well. Next slide, please. Talking a little bit about portfolio, really important that we have diversification, and that's across both the sort of numbers of businesses, probably in the region of about 70, but also very importantly, the balance of sectors in which we're invested. And just this has been a theme I've been talking to over the last few shareholder seminars, and it's really the move away from more asset-based investing to where the world is very much going now, which is healthcare and software and other technology. So what you're seeing here is over a quarter of the portfolio is in software and technology, healthcare, which does include our care homes, at about 23%. Cash at this point in 30th of June was relatively high at 30%. 20% would be our more normal target, reflected some very strong exits, but we have made a number of investments in the months since June, so that has come down somewhat. Bottom right hand segments of this pie chart, we've got education, which is our 2 schools at 4%, now relatively small in the overall portfolio, but we do still have that exposure to renewable energy at some 12%, and that's a mixture of solar, wind, and hydro. Certainly assets that we would anticipate holding for a decent period of time, given the long-term nature of their revenue streams. Next slide, please. So just sort of showing how the portfolio has developed. This is looking at how the asset-based portfolio has reduced as we've exited. So we exited particularly one of our schools, but we also sold a hotel, and we also sold a number of pubs right at the back end of last year. So I did refer to them at this same seminar when I talked to you last year. So what you see there is that the asset-based element was sitting at about 42% a year ago. That has now come down to 31%. So you are seeing that anticipated move away from the asset-based portfolio. Growth has stayed relatively static, and that really reflects the exit of both the asset bases, but we also did have some nice exits that came out of our growth portfolio. So what you're seeing there is those exits sort of turning into cash, cash being the 30%, and that is what we've been hard at work investing over the last few months. Next slide, please. Giving you a sense of what the portfolio looks like. So as well as being diversified across sectors, I'm also keen that we have a range of businesses in terms of size. So on the basis that larger businesses should be less volatile than smaller ones, I'm always keen to keep an eye on how the portfolio is developing as businesses grow within the portfolio. And I really do this in 2 ways. I look at it in terms of the number of employees. It gives you a sense of scale, and then I'll come on to looking at it by revenue. So as we sit here today, we've now got sort of 54% of the invested portfolio, and that's by value, is now invested in businesses of over 54%. Important to point out that renewable energy accounts for 17%. That's of the actual invested portfolio. My previous number was of the whole NAV at 12%. So if you could, what you're seeing is a significant businesses growing as the portfolio matures, hopefully helping us with the controlling the volatility. But let's move to the next slide, please, and look at revenue. So we define early stage as companies with revenues of less than $1 million, and I keep an eye on that. It's an important part of our investment strategy because the early stage businesses, we look to grow and invest in them further. So sitting at about 12% is sort of very much in the sort of realms of where we would want the exposure to be to what are particularly young companies. But what we're also seeing here is as companies grow, that actually we've got decent exposure to businesses with portfolio of more than $1 million, but less than 5, with 40%. But encouragingly, we also have now some 45% of portfolio is in businesses with revenues of more than 5 million. So yes, we are backing early stage businesses. It's an important part of what we do, but what we're also seeing is those businesses growing and developing into more mature. And it is very much my wish that we should continue to invest and support those businesses through their growth cycle. So looking to back our winners but importantly, growing substantial businesses to the benefit of the broader UK economy, and very much in line with Her Majesty's Treasury's policy, which supports VCTs through a very generous tax break. Next slide, please. What you will increasingly see is, and this is to my last point, is that there will be a number of businesses that become very much the stars of the portfolio. So I've picked the three largest companies here, which as at June were valued collectively at about 70 million. So these are a significant element of the portfolio. So definitely worth highlighting them. And this really reflects the supporting our winners and running our winners. So the three here, which I will just touch on, many of you will have who've listened to other presentations will be familiar with them. We've got Quantexa, which is provides a very important platform particularly to banks to help them analyze vast amounts of data, particularly in defense of financial crime. Very much a theme that we've been picking up in this conference today. Egress, similarly, hugely important piece of technology, which allows the very secure encryption of email and also the exchange of data. So that has benefited in COVID. They're now used across the NHS and were rapidly implemented as many hospitals and other areas of the NHS found themselves working from home. And then lastly, Pravica. Chris, the chairman, was on the earlier panel, has continued to do very exciting things in terms of developing drugs focused on children and getting them licensed specifically for and formulated for children. So touching on this, you see some very significant growth. Quantexa, 3 million invested, worth 23. Egress 8, also worth 23. 23 is a bit of a theme of the slide, by the way. And 7 million Pravica now worth 23. So you're seeing real creation of value, and that's demonstrated again just by the growth in revenues. 20 times for Quantexa, 10 times for Egress, and Pravica starting from almost nothing, and given us that we invested very much at the very early stage of their journey. So these are really exciting businesses that your investment in us is enabling and helping to happen. Next slide, please. Very quick, our latest new investment, and I've put it in because it is so recent, and it's just really to give you a flavour of some of the sort of things we're doing. So this we led a 7 million round, of which we put in a decent chunk of that. And what Selden does is it helps big enterprises, and you can see some great names here: AstraZeneca, Walmart, Mastercard, Amex, Nasdaq and Ford. These are all large enterprises with huge amounts of data and huge amounts of requirement to use machine learning as a way of improving their processes particularly through automation. But machine learning is something you hear a lot about. What isn't talked about as much is actually just how difficult it is to manage all these what are known as machine learning models that are created to enable automation and other processes, but then need to be continuously refined, developed. And this is where Selden steps in. They provide a platform that is able to work across all the different sort of cloud providers, whether that's cloud, whether that's Google, whether that's Amazon. But importantly, it's saving huge amounts of time and therefore money within enterprises as they increasingly make use of machine learning. So very much at the forefront of where software and development is going. Interesting, this one, they have a significant open source element to the proposition. So as well as selling to enterprises, they also provide it on an open source basis. So it's the first time we've been involved in the area of open source. So it's proven to be very interesting. Next slide, please. Pick up a few of the other investments, and I won't go into too much detail, but just to give you a sense, what you will see here is that we have increased our exposure to fintech. That's backing businesses in the area of financial technology. So software that allows financial institutions to operate in a more effective way. So Credit Kudos is a good example. It's of automation. They help those providing credit to make quicker lending decisions through analysing data that comes out of banks. So if you think you can now have your bank statements can now be delivered in electronic format through open banking, and Credit Kudos is able to analyse what all those different transactions are. Really useful. I don't know if any of you have been through mortgage applications recently, but it's able to then very quickly analyse your spending into all the different categories, whether that's utility bills and the like, massively improving the effectiveness and the speed of credit making decisions. Consiris is helping insurers make better decisions, particularly in the area of marine and transport. So this is about using data to make better risk decisions. UMATIF, one of it was a follow-on investment that we made into one of our businesses that support clinical trials, and it's very much focused at providing a platform that really engages with those in the trial in terms of harvesting data for pharma and indeed regulators. Transfic very much in the financial technology arena. It's a platform that helps trading entities within banks connect to all the different venues they're called. So this is particularly on fixed income. And then finally, WeGift is helping a whole range of enterprises access electronic gift cards. So the days of the gift cards that you might have gone and bought in a supermarket or been sent through the post is rapidly moving to these gift cards being digital, sent to you typically by email or the like. But what that's done is that's created a huge opportunity for WeGift to provide the necessary software platform to enable a whole range of customers to be able to manage gift cards, and that might be employers giving gift cards to their employees, but also very much where they're used as part of marketing incentives and to encourage new customers. So offering gift cards, for example, if you sign up for a particular product or service. Next slide, please. Very important that we have exits. So the Clear Review was an interesting one. It was we only invested it in June 2019. So I think it wins the prize for the quickest exit that we've had after investment. So we only invested back in June 2019, and it was sold to a software business called Advance in October 2020. It's the software was all around performance management. It's to help with the appraisal of staff, and it provided sort of continuous appraisals. It was growing rapidly. We were approached by Advance, who had a particular need to add Clear Review to their broader software portfolio. So in a very short period of time, we were able to deliver a 2.1 times return, and because of the short holding period, an extremely high internal rate of return of over 70%. Next slide, please. Many of you will have picked up from annual reports or through attending AGMs that we have changed the way we calculate dividends this year. And this is really to better reflect the type of portfolio that we're building. So what we now do is we continue to aim for a dividend yield of around 5%. But the way we calculate it is that we calculated it as 2.5% of the NAV at each half year, so hence broadly 5% over the whole year. And what this allows is it makes sure that the dividend remains sustainable. So if NAVs go down, it will reduce the dividend to make sure that we're not effectively paying out too much capital, but equally well to the benefit of shareholders. If any NAVs rise, the dividend rises with it. So you get more immediate. The dividend is more immediately linked to the underlying performance of the VCTs. So that's now been introduced across all the VCTs. So you will see variable dividends rather than the historic fixed ones that where we used to operate. Next slide, please. So what's going to happen from here? Not an easy one in these times, but I think it's fair to say that we sort of have got a better handle on the impact of COVID-19. And I talked earlier about the relative resilience of the portfolio, and many of the themes that we've backed will continue. And as indeed you heard in the healthcare panel just now, and we have got some businesses that are thriving and are doing very well. And I gave you the three at the top of the three largest in our portfolio, which are good examples. So, you know, we are optimistic that the companies and the sectors that we are targeting are the right place to be at a time of great uncertainty. But equally well, you've all just sat through Trevor's excellent presentation, which did not paint a particularly optimistic view of the economy going forward, and clearly highlighted some major headwinds. So there is some unknowns. What we can do though is we can continue to work very hard on your behalf to invest in those businesses that we believe will be net beneficiaries rather than detractors as a result of COVID, and that's very much in the areas I've highlighted on the slide. You know, digital health, data analytics, automation, financial technology, and indeed the whole area of digital security, including cybersecurity. So going forward, we've got some really interesting investments in the portfolio. From those, we see potential for growth, but inevitably, one has to have a weather eye on what the broader economy is doing. And realistically, because of the nature of investing in young, particularly technology and healthcare businesses, you know, there is the potential for volatility, but with that comes the potential for overperformance. So we remain optimistic, but equally well sensibly cautious as the world develops around us. Next slide, please. Couple of things just to pick up. One sort of inevitable consequence of lockdown and COVID is the importance of communicating with our shareholders electronically. And if I could very much encourage shareholders to consider signing up to receive things electronically. In fact, we're so keen that people should do that, and for a number of reasons that I'll go through, that we're keen that those that do sign up for each one, we are going to, and this is Albion, are going to donate a £1 towards a coronavirus charity that we're all busy trying to select. And there are many benefits for electronic communications, and by that I mean getting your annual reports and reading them online. Not everything can be done electronically, but the vast amount can. So, for example, receiving fundraising documentation, you know, investor guides and the like. There are lots of advantages of this. There's less people out and about delivering stuff at a time when we're very much being encouraged to reduce the movement of people as we work our way through this virus. There's a big environmental benefit of all of this. In the reduced waste of printing. There's a cost benefit for the VCTs in terms of reduced printing costs and actually reduced postage. But most importantly, you get information in a tiny manner and in a more reliable way. And then finally, sort of really talking about what we're doing now. You know, we are having to do more and more remotely. We are doing AGMs now remotely using Zoom. We want to build on our experience over this year and improve the experience. And I'm absolutely delighted to see that there are literally hundreds of you listening to this presentation today. So a benefit has been actually that I feel able to engage with a lot more people as we navigate our way through. Next slide, please. Fraud. I don't want to overly labour this, given Jenny's talk earlier, but please be so careful of where you are contacted in relation to your Albion VCTs. What are known as boiler room scams are absolutely rife, and this is where where you'll be rung by somebody claiming to be a corporate finance house acting on the takeover of such and such an Albion VCT. Look, it's just nonsense. They're after your money. Please be on your guard. If you're ever concerned about something, err on the side of the caution. drop an email to info@albion.capital. Pick up the phone. Our phone numbers are on the website. Please be cautious. We have had a number of shareholders who've been approached by these, frankly, rather despicable fraudsters. Next slide, please. So with that, I'd like to move on to Q&As. I am conscious that we are right up against time, and I really hope people can stay for the Q&A. So if I could hand over to Patrick.
Great, thank you, Will. That was a great presentation, very comprehensive, really, really good. We've now got a fantastic panel, and we've got a lot of questions in the Q&A section. So we'll, yes, we are slightly time limited, but I'll get through as many as we can. Now, do we have a panel? Great. Okay, so I'm going to try and go on to my question thing. Trevor, first one is for you. How do you think that the government will repay the debt rise, austerity, taxation, or inflation? And where do you think that the tax burden will fall, individuals or businesses? You have 35 seconds to answer.
Yeah, I mean, it's a great question. I don't think it'll be austerity. We've done that for the last 10 years. What we've done is to destroy too much of what is actually, we've now figured out is valuable. So that won't be done. Growth is the best way of getting down deficits in the long run, which is what my long run chart suggested. And that's what the focus should be. How do we grow our way out of this? And I think the discussion around technology and health is only one aspect of technology, by the way. The digitization and the wave of innovation that unleashed is only just beginning. And so I think there is a lot more that can be done across more industries than ever before. So encouragement of that, 5G, investment in education around the technologies which will enable the jobs of tomorrow, that's where the focus should be. But there will be some tax rises. I think they'll be on the wealthy, top end of individuals who've had capital gains, unfortunately, over the last 20 years or so. And I think potentially some business taxes will go up as well. I don't think it's going to fall on those on average incomes and on individuals on average income. Top end, it will be. Inflation, I think there won't be any inflation because we won't be growing fast enough to generate inflation for the next few years.
Great, thank you, Trevor. That's really helpful. The next one I think is a very, God, sorry about that, grandfather clock. I thought I turned it off. Right, Will, one for you, easy one. Are you planning fundraising this season?
Yes, indeed. So I'm just in the process at the moment of making a recommendation to the various VCT boards on their fundraising strategy. I hope to be in a position to put out some announcement on this very subject over the next week or so. The plan would be to launch a fundraising in early January, all things being equal. So the answer is yes. And if I could just mention one more plug for electronic, again, we will be doing our applications online this year, and this is really to help make the process more efficiently, but in the times of lockdown that we live in, to make things safer and easier. So please, can I very much encourage people to apply online this year.
Thank you for that. Okay, so Andrew, we've got a healthcare question. It's quite a long one. I run 3 pharmacos and Lexon UK Holdings, which I think are a national healthcare distributor, and identify generic drug strengths. We have recently formed a digital arm. What should we do to Chris and Andrew? Actually, that's probably offline, isn't it?
That's an offline question. Yeah.
That is definitely an offline. Okay, I'm going to give you another one then. What have been the highs and importantly the lows within the healthcare portfolio over the last year?
Okay. Well, I think I can confidently say that the highs have well outweighed the lows. So if you remember from our portfolio slide, we have 14 companies in the portfolio, and 8 of those have been growing strongly as a result and through the COVID period. They've been growing strongly anyway, but actually accelerated because of COVID. 2 of those are growing strongly anyway, irrespective of what's going on with COVID. So 10 out of the 14 are growing very strongly. 2 are unaffected by the COVID pandemic, and to have had short-term headwinds as a result of COVID, and those are the ones which are selling into hospitals. So just focusing on the reasons why things have lowlights first, because let's get them out of the way. The lowlights are those companies selling into hospitals. Hospitals been massively distracted, just in terms of keeping care on the on the road, and just sales cycles that have just sort of ground to a halt in some aspects if you're selling direct to hospital. But fortunately, those technologies which are actually helping hospitals deliver care or helping pharmaceutical companies access patients for their clinical trials, those have all been going gangbusters. And so Umotif has doubled through the COVID period. Cysiv has doubled. Helios, we saw earlier with Rich, that has grown 4 times through the period. Oviva has added 3 times more patients through the COVID period. Locum's Nest has been delivering for the NHS and growing fast as well. Pando has doubled its network, 3 times its engagement. Sales cycles have shortened in all those companies from months, sometimes to days. So that's really, really good. So I think, yeah, in general, things are looking good for the health technology portfolio and health portfolio in general over the next 5 years.
Great, thanks, Andrew. Can I move on to Jess? Jess is a US citizen. Jess, many of the tech investments are looking to expand into America. How do you think the election results could affect that growth?
I think there could be 3 interesting impacts. The first is big tech competition policy. I think the US government and the Department of Justice will continue what started in the Trump administration and should continue under Biden, suits against the Googles, Amazons, Apples, Microsofts of the world. The first one being against Google for monopoly power in search. This should be good for new entrants to the country, to the market, like our portfolio companies and new smaller competitors. The second impact, I think, would be in life sciences research. Biden has a personal interest in spending much more money on clinical research, particularly around trying to cure cancer and Alzheimer's, both diseases which were called out in his acceptance speech. There should be a lot more money flowing into the sorts of clinical trials that our technology, that our portfolio helps enable. So that should be positive. And then finally, I think the incoming administration will have a big emphasis on value-based healthcare. So getting the best health outcomes for the dollars spent. And several of our investments in digital health, in digital therapeutics, are good value for money, and so should be positive for their prospects in the States.
Yes, that's really helpful. Now, the next question is actually a really interesting one. I'm not entirely sure that we're hugely qualified to respond, but Robert, I'm going to ask you the question anyway, and see where we get to. So, will the decline in the traditional retail high street model continue, or are there possibilities of repurposing the high street? So that's a googly. Robert, what do you think?
Yes. So I think for everyone, everyone's seen, there's been a cultural shift that's affected everyone, not just businesses in our portfolio, but also consumers. You haven't had a choice but to use Amazon if you want, certain non-essential supplies. I think people have just got more comfortable, more used to it, and have seen the benefits of and efficiency of and cost advantages of an online model. So I can't see that. There will be, as people like Chris referred to and everyone referred to, we're all human beings, we're all social animals. There will be a burst of getting back into face-to-face context and that sort of stuff. But I think the proportion of spending that's online will continue to rise.
Great, thank you for that. I've now got another one for you, Trevor, if that's okay.
Just quickly, though, just to add to the excellent point that was made, the repurposing of the high street will continue apace, because that was part of the question too. So I think it will become much more social spaces, to the point about we are social animals, we need to be close to each other. And so I think there's huge opportunity to have a mix of different types of boutique type businesses on the high street and actually make it much more dynamic.
You mean lots more pubs. So I think that's quite civilized, really. I can buy into that. Okay, quick one for you, Trevor. What is the longer term outlook for inflation, and what do you think is going to drive it? Do you think it's going to be damp, or do you think it's going to start to soar following all the QE?
Well, there's two parts to the answer. On the one hand, if you do look at the growth in the money supply and the huge amount of printing of money that's going on through QE, purchasing of government debt, you'd have thought that with a huge rise in money supply that has brought about, that is inflationary in of itself. And so that's a warning sign for sure, that policy needs to be tightened once growth accelerates to the point where it's matching the supply capacity. That's the trick that policymakers have to pull off. But I think that's 2 or 3 years away. If they don't pull off that trick and raise interest rates from ultra low levels at the right time, we have a chance of excessive levels of inflation. Some economists do argue that this is what's going to happen. On the other hand, if you do look at what occurs in an aging population, and in all of the Western economies are aging, ours is aging, it's aging more slowly than Europe, but it is aging. Germany's population is shrinking. In that environment, you don't get inflation. So I suspect that it's going to be a very mixed picture amongst the industrialized countries. Those who get it right have low inflation. Those who don't may end up with high inflation.
Because inflation and therefore interest rates could be disastrous, couldn't they? Okay. Will, one for you on the government, really, and their attitude. What comforts do you get that the government will continue to support VCTs?
So it's a very good question. It's one that is never far from my mind. Very conscious that the role that VCTs need to perform, and that is to grow businesses. And I think what's really important is that we are part of the recovery story. So I think, and Trevor will no doubt have views on this, but certainly my view is that the growth of technology, digital business and healthcare, and the growth of the SME will be really important in that recovery, just by terms of the pure numbers of people employed and the growth rates that can be done. Those businesses will need funding. There is capital. If you want to grow businesses quickly, they must have access to capital, and VCTs provide that capital. So I would very much be of the view that Treasury recognises and the government more broadly recognises this and sees considerable value in the tax break that is given to VCTs and allow us to be part of that recovery story.
Thanks, Will. I've got a healthcare question, quite an interesting one. I think I understand it. Is healthcare content keeping pace with technological development? In other words, are the services provided keeping up to date with the ability to deliver them?
I saw that. I wasn't quite sure what healthcare content referred to, but if you mean healthcare services keeping up with technology, then I think aspects of it are keeping up, but healthcare often is a laggard, and so in terms of the adoption of new technologies into the front line of general care, you can assume that generally it takes quite a long time for these to come through. COVID is an exception, but I think as we've seen before, it's going to be accelerating. But there definitely is a big gap between the delivery of healthcare services and the sort of cutting edge of technologies. And that's there for a good reason. It's there to avoid adoption of technologies which can do us harm or certainly not do us any good and cost a lot of additional money. So regulators are there in place. Clinicians focus very highly on making sure there's good evidence before using new technologies. I think what we've seen is that there's an increasing acceptance that actually you can gather evidence on the go, and sometimes where the benefits massively outweigh the risks, you're better off adopting it and running with it and gathering the evidence as you go, rather than waiting for 10 years to have built your body of evidence before you even think about adopting a new technology. So I think we're going to see that sort of incremental step start to sort of, the slope to flatten and not be quite such a cliff. But I think there's always going to be, and I think it's in our interests that there always is a bit of a lag whilst we understand the safety of new technologies.
Thank you, Andrew. Now, I'm afraid we've only got time for 2 more questions. So, and we do have a fair amount that we still haven't answered. So can I first of all apologize to everyone for that? We will provide written answers over the next few days, and thank you for putting them in. I've got 1 question for you, Robert, and 1 question for Jess. Robert, a question for you really is, we weathered the first lockdown all right. What's your view on the portfolio effect for the second lockdown?
Thank you, Patrick. So less, smaller. So the lockdown very much should be shorter, much shorter. We, as you mentioned, Patrick, we've adapted, the portfolio is adapted, and therefore better able to deal with the challenges of lockdown. And I think as Trevor highlighted, there are winners and losers. Unfortunately, our portfolio is exposed to software and healthcare, which are both in the winner category. And as Will mentioned, we showed resilient growth in the first lockdown, and I would expect more of the same in the second.
Great, thank you for that. Jess, you got the honour of having the final question. What are the sectors that really excite you at the moment?
Well, I think this past year has just reinforced our conviction in investing in software, and particularly software for businesses. I think we think that the business digital transformation is still in the early innings, and COVID has shown us that many sectors that thought they didn't need to be digital actually do need to have a technology strategy, whether that's using software to enable a digital workforce or a hybrid workforce, digital distribution of your products, whether that's e-commerce or digital sales and marketing. So I think we're still very bullish on digital transformation overall.
Great, well, thank you, Jess. That's very helpful. Can I thank everyone? There are just under 300 people on the call, which I think is the biggest one I've been to. If you can, pretend you can smell the waft of delicious canapes from next door. You can hear the gentle popping of wine bottles. And as you reach the fridge, grab something nice. So thank you for attending. It's been great having you here. Do give us feedback as to how we can improve it. Stay safe and see you soon. Thank you very much.